So let's go back to part one of our plan. How much return on investment do you want realistically? Now, as I said before, charting or technical analysis is a visual interpretation of what prices are doing. Okay? Now here is a very basic chart, and this is an older chart of Discovery Holdings. Now, initially, it just looks like a chart that goes up and down. But as a technical analyst, this actually tells you a lot more about what's going on with this share price. Okay, so let's first see what's the first thing that I see when I look at this chart. We can see that this chart or this price has made a high and then subsequently come off to a level to make a retest of that previous high before falling back down again. As you can see on the bottom of this chart, this has spanned over a few months. So from October last year, November, December, January, up to February, almost ending at March. What else do we see on this chart? Quite a lot of information. So this simple chart actually starts looking a little bit complicated, but it isn't, because we're talking about investments. Now remember, one of the things I alluded to was set your entry and take profit and stop losses in when entering your trade, and this is exactly why. So now look at the information this trade or this chart has given me. I know, or I can see, that it made a low point at some stage in October to make a high before selling off, to retest the previous low where it bounced. Now guys, a lot of guys would have waited for this low to be confirmed, and now when we go back to how much are you prepared to lose, we can see that kind of failed over there. But this goes back to being realistic about your expectations of what the share price is going to do. I'm going to get into a lot more detail, but I just want you to see that a simple chart actually conveys quite an important message and has a lot of detail in it. So if you had bought this stock at a support level similar to the previous low, you should theoretically, by that logic, also not be too greedy and probably get out when it retests that previous high. But let's say we got in a little bit late, and this is part of the plan. Go back to set your entry, your take profit, and your stop loss levels when entering a trade, because trades can go wrong. So let's say we wanted to get in now on the third test of the low for a profit target for a retest of those highs. We would have had to enter a stop loss level in case this goes wrong, because they do go wrong. So we would have put our buy price similar to these lows. We would have put our take profit very close to those old highs and a stop loss level just below these lows. Okay, this trade obviously would have gone against us, and if we had not gotten out at the right time, we would have probably lost roughly about 30% of our investment. Now, nobody wants to do that when they're investing, and that's why you need to cut your losers early, because there's another cost to you as an investor, and that's called opportunity cost. Missing out on the next trade because you're stuck in a bad one is just as much, if not more of a sin, than losing out on any profits. So typically, an investor would need to be patient, wait for this share price to recover, get back above those old previous lows before getting back into this stock. And guys, this chart goes back a little bit, and on a retest, I bought this stock around about the 70s, and I think Discovery today is trading at about 96 Rand. So this is just to give you the principle behind having the plan before you get in, and be realistic about how much you're prepared to make, and how much are you prepared to lose is probably more important because of the opportunity cost. Now, liquidity, as I referred to earlier, is of paramount importance. You need to be able to get in at a good price, and it must be easy for you to get out when you want to take profit. Okay, so here, side by side, you might have to sit a little bit closer to your screen, as the slide might be a little bit small, but at a specific time during the day, let's call it 12:30 in the afternoon, here is an order book of two very different stocks. We have a very liquid Sasol and a very obscure Hwangi Collieries Limited at exactly the same time of the day. Now look at the difference between these two stocks, and this is what I talk about when I talk about liquidity. On the order book currently, or at 12:30 in the afternoon, Sasol, on the buy side of the order book, has got 128,000 shares that are prepared to be bought at various prices, as well as 81,000 on the sell side. But you can also see that the bid-offer spread is very close. In other words, the buyer wants to buy at 129 Rand and 30 cents, call it, and the seller is prepared to sell at 629.84. Now, you don't have to cross a very, very wide double to get in or out of this market. You might forgive yourself a few cents for the ability to get out of a trade, or in for that matter. But as you can see, there's active trading that's happening in a liquid stock like Sasol. At the same time of the day, we have an illiquid stock. And this is the problem. For all you guys that are trading those penny stocks and wondering why you've been waiting for that 10-bagger to come in and you keep losing money, it's probably because it's very difficult to get out of those stocks. And very importantly, the bid-offer spreads tend to be very wide. And by that I mean the best buyer on this specific stock is sitting at 60 cents, and the best seller is not prepared to sell lower than 1 Rand 50. Now guys, you have to be a fool to pay 60% more for a stock you want to hold. Because remember, when it's time to sell, you're probably going to sell it for 60% less than what it's worth. And that is not the purpose of investing. So very important, trade liquid instruments. And I think this depicts exactly why you need to look for those liquid stocks.